this call in connection with discussion regarding break-even analysis. I hope that this is going to be beneficial for you. I think it's a critical piece for all small business owners to go through this exercise. And even if you're not in a break-even problem, you can use the same exercise for targeting certain profitability levels. And so we're going to go into that a little bit too. So to start with, why do we even care about a break-even analysis? And, for some people right now during this pandemic, it's a function of survival. I need to know if I can cover my bills. And so that's where it is it's a useful tool for doing that. It also, in a normal environment, it's a great thing for deciding what your goals are and achieving them, because you can say, okay, I would like to make $200,000 this year. You back into how much you have to do in sales, and then you start working through your plans for what you need to do. So I think this is where break-even analysis gets a little bit of a bad rap, because we don't think about it in the normal situations, but it's useful at all times. And then that leads into budgeting and planning. And again, this is something that small business owners frequently don't do enough of. And that's where we really want to encourage you to use this as a tool to move forward. So let's open up with, what are some of the key terms we got to deal with? And I'm going to start with accrual accounting. And this is something that I know we've talked about in the past, but it gets overlooked a little bit. Accrual accounting is really about matching up your expenses with the income as it's earned. And we really have to have that in place to really do a true break-even analysis, because we have to have all of our expenses recorded and we have to have all of our revenue recorded. And so this is where it's really critical that your accounting system is working right. But then we get into this fixed versus variable. And what are fixed costs? Fixed costs are costs that are fixed. It's pretty straightforward. You know what your rent's going to be for next year. You know what your utilities are probably going to be. Now, if you're in a retail environment, rent could be variable because it could be a % of sales. So this is where things get a little fuzzy, and it's a matter of figuring out what you really have. Your variable costs are going to go up with sales. They're going to go up almost dollar for dollar. Sometimes it's not a complete exact increase, but it's pretty close. Bottom line is, if you got a business doing $1 million and you have $100,000 in payroll, and next year you're going to do 2 million and you're going to have 200,000 in payroll, then that's a variable cost, and it's pretty simple. And the other couple terms we have to talk about are discretionary versus non-discretionary. Discretionary are ones that are, obviously you can just decide to do them or not. Like right now, marketing expenses might be discretionary if your business is closed. Whereas non-discretionary expenses are ones you've already committed to. Your rent, it could be payroll, it could be utilities, could be a lot of different things. So you don't have as much choice over the non-discretionary ones. Discretionary ones require some decision making on that. And we're going to get a little more into that a little later. And then the last big thing I wanted to talk about is variable margin. And what this is basically sales less your variable cost, and then that result as a % of sales. And it sounds simple enough, but this is a key piece in calculating break even. And we're going to walk through an example on this. So where do we start? We start with your ownership and financial team. That we need to get the right people looking at your business and looking at it in the right manner, because we want to really tear the thing apart. And we're going to start with your income statement. So I'm going to share my screen here right now. and we're going to look at a sample income statement that is set up, and I've done this, I've taken it and exported it to Excel, and so I did a little bit of manipulation. And this is a sample company out of QuickBooks. But what I did was I said, okay, here's our company, and what are variable versus fixed costs? And so we've gone through and identified them. And so we're starting off with your revenue up here. Then we have our job costs and labor, and we come up with gross profit. And I'm assuming for this example that these are all variable. Now we're coming down to the overhead part, and this is where there's some variable in overhead, because these expenses here are going to go up and down based on revenue generally, and it's not always perfect, and sometimes there's some mixed things in there, but generally this is going to be the case. And this is where we come down to this variable margin, and that's where this is, you know, strictly the gross profit less your variable cost equals your variable margin, and then here's our variable margin percentage. Then below here are our fixed overhead costs. And again, I've sorted this so that it works out this way, but you got to go through your whole chart of accounts and your whole income statement to see what is really fixed versus variable. So I'm assuming these are all fixed. So we come on with total fixed cost. Now we also could have, when we were discussing discretionary versus non-discretionary, any one of these things could be discretionary versus non-discretionary. We could have discretionary down here and non-discretionary up here, or vice versa. You know, you could have, like I said, marketing expenses could be discretionary, but you could have some of your job costs could be discretionary. If you were selling a product and you packaged it a certain way, and it costs 100%, or costs 50% more than what your competitors do, but you're doing it for branding and other purposes. Well, that's discretionary. And I'm not saying it's a bad idea. I'm just saying it is discretionary. It is something you could change to change your variable cost. So when we're doing this break even, we're going to take our income statement and we're just going to go line by line and put variable or fixed. And again, this is a simple example, but it gives you an idea what we're trying to do. And so once we've done that and we know what our variable margin is and what our total variable costs, our total fixed costs are, then we can actually do a break-even calculation. And the break-even calculation is as simple as taking our fixed cost divided by variable margin, and it tells me that my break-even sales for this business is $565,000. Now, that's pretty simple. And if we go back to the income statement, we see that the sales are, for this break-even column, 565. These are all the same percentage of sales for this break-even calculation. And we come down to margin of 223. Our fixed costs are the same, and we break even. Okay. And then over here, this is where we're talking about the targeted profit break-even calculation. And this is where you take your fixed cost plus your profit goal. So if I assumed I wanted to make $200,000, I would take our fixed cost of 223 plus the 200 and then divide by 39.5 and come up with $1,071,000. And the proof of that is if when you go back over to your income statement, if I take the $1,071,000 and then I multiply each of these percentages, which are variable, times the $1,071,000, I come up with our costs, come up with our gross profit. Same with these percentages times sales equals these numbers. And then I end up with variable margin of 423. My fixed costs are the same, and I ended up with a $200,000 profit. Pretty straightforward. So if I want to achieve 200,000, I have to hit $1,071,000. And if I'm at 820 now, it's like, okay, I need to do 200, $50,000 more in sales. And I could, at the same time, I could also lose 260,000 between here and here, and I would still break even. I would go from making 100 down to breaking even at a buck. So this is the nuts and bolts of the break even calculations. And it's simple, but it takes some time, and you just got to wade through it. So the issue is, what do we do with it? And when we're looking at these examples, we're going to do a first pass, and then maybe you end up with something you don't like. It's a little too big a number or whatever. So we have to test it. We have to test it against your monthly financials going forward. Does this still make sense? We have to evaluate the assumptions. Do we have the right fixed versus variable? Is there anything else coming into play? And again, when you start using these things on a monthly or quarterly basis, and if you're not coming up with the right answer, then there's something wrong, and you can go back and figure it out. And then we revise our plans based on this. Once we get it working, it's like, okay, now what are we going to do? We're going to push to sell more. We're going to push to sell less. It could be we're better off selling less. The point is, this is going to help us make decisions for what we're going to do tomorrow, next month, and next year. I'm going to hit a couple problem areas though with break even, because it's not as clean as you might think. One of the issues is volume ranges. And if you are in a business, and I'm going to share the screen again. So if you're in this business and you're doing 820,000 in revenue, and if you are completely at capacity, then this calculation is wrong. And the reason being, if you're completely at capacity, then when you want to go up in sales, you're going to end up with a situation where you're going to have to add some payroll. There may be a few other expenses. You may have to buy some additional trucks. You're going to have more depreciation. Just different things are going to go up. And so you have to know where you are as opposed to capacity. And you might be at capacity for people, which obviously you can go up and you hire more, and that's fine. Or you could be a capacity in the overhead area, or vice versa. So this is where looking at your capacity and thinking about it, it's important to look at the volume ranges, because frequently when you're doing a certain calculation like this, it works within a certain volume range, but then it's like a step function. So if all of a sudden you hit, the magic number may be 1.5 million in this business, and then, okay, we got to add another production foreman, and we need a bidder, we need an estimator, and blah 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 blah. And all of a sudden, we've added $100,000 overhead, and then plus we need some office people to support them, and all of a sudden the calculations are going to be off a little bit, and that's where we have to be cognizant of that. So that's when we have to blend that in. So that's this gets into some budgeting issues, and we talked about a couple of weeks ago with cash flow plans. So just be aware of that. The other big thing is misclassification of costs. I said rent was fixed, but all of a sudden maybe there's fixed component, but there's a percentage of revenue kicker. You're in a mall or whatever. There's some pieces that can be variable with the fix, so you may have to account for that in this. And we end up with some decisions that are made wrong if we're not real careful with this. And the other part of this is somebody may be looking at it and say, okay, I can break even and I'm still going to go broke because I got so much debt load. And so you can do a version of this with debt service. It's not perfect. And when you get into that too far, you really want to look at a cash flow plan. But you can do a version of this by adding on additional fixed costs for your debt service and pulling out your depreciation. There's a couple things, a couple small adjustments, and we can talk about that if there's anybody that really wants to get into that. So I've walked through the break-even analysis pretty quickly, and the issue is, what is the key takeaway out of this? Hopefully, when you get through with this, you understand your income statement better. That's a big thing, because your income statement, if you understand what levers you can adjust and it's going to do this or that, then it makes a big difference in your decision making. It helps you with budgeting, because as you start thinking these things through, you're digging into the details. And a budget is really, the application of your strategy. What are you trying to accomplish? And the other part of this, by going through this exercise, is you start understanding the importance of the reluctance to add fixed costs. When you add fixed costs, then all of a sudden you have to recover so much more to sell because of the variable margin. And that's where you start looking at those. It's not that adding fixed costs is bad. It's just you have to be making intelligent decisions on this. You need to be, run as lean as you can, especially in the current environment. So that's the core of the break even. I hope this has been beneficial. If you have any questions, please ask them now and on the chat box, or shoot me an email and I'll try to answer as many as I can. Okay, let's see here. Okay, we have a couple things. How do I really know if an expense is fixed or variable? One of the things that you can do is look at like a 5-year history on an income statement and see, is that expense, does it stay the same percentage-wise of sales that, for each of the years? Now, you might have something like, say, a credit card fee, where it's 2% of sales, and then all of a sudden it goes to 3%. Well, that's because the credit card fee adjusted your percentage. That's fine. That means it's perfectly fixed. But, if it's going up pretty much in line with your sales, then it probably is variable. And then you can look at how you're billed for that service and make some decisions. Okay. Let's see. Oh, how do you tell what goes into overhead? This is another great question. I'm not as concerned about what is overhead versus what is cost of goods sold. I think it's, important, and for GAAP purposes, you got to do all the things right. But what's more important for making decisions is what's fixed versus variable. I want, in cost of goods sold, I want all my direct costs, period. And then I want to have a section for indirect costs that are generally going to be variable. They're going to go up and down with sales. They're not directly related, but they're close. And then I want all of my fixed costs generally in one area. Now, I might have some fixed costs in cost of goods sold. That is possible. So if that's the case, then we just have to be aware of it. And we have to set up our formulas to accomplish that. But I think this is more important than looking at what's overhead. I think it's more important to say, here's fixed, here's my variable, here's how what levers I can run. So would I recommend doing this exercise before jumping in a whole cash flow plan? Generally, this is probably a good idea to do before you do a cash flow plan, but maybe not. You could do the cash flow plan and then do this. They're both necessary and they tie together and they will supplement each other. So there are going to be some consistencies there. So I think the key is whichever one you feel comfortable with, that's the one you should do first, and then you do the other. And then, for fixed versus variable question, how does the expense go up when sales go up? And again, it's just going back to if sales double, is that expense going to double? And if so, then it's going to be variable. This is going to be like labor in the lawn care business. It could be sales commissions, because you're paying a 6% sales commission on sales. Well, it's clear, every extra dollar you sell, you're going to pay 6%. That's going to be a clear variable cost. And then the last question I have here is, how does it tie into a personal situation? And again, this is something that most small business owners need to think about. You may have had 4 or 5 really good years and you're pulling good money out of the business. And then all of a sudden we hit this clunker of a 2020. You may need to rethink how much you should be pulling out. And that will impact what your break even is. Because your break even is going to be tied to what, one of the things is going to be how much salary and you're going to be pulling out. So this is the thing where it's important to look at your personal situation, and maybe you have to cut back something. It's hard to say, but they are tied together. So I think that was pretty much all the questions. So if you have anything else, please let me know. Shoot me an email or call, and I'll be glad to answer whatever I can. Thank you again, and I will be sending out a copy of this recording as soon as I can get it put together. Thanks again. Have a great day.